All right, the markets followed through on yesterday's pretty sharp decline coming out of options expiration and the holiday weekend with a little bit of a down move today. Again, trying to threaten the 4,000 mark on the S&P 500, 33,000 on the Dow. Not quite really breaking it. So we're going to take a look to see whether or not that gives us the juice that we need to really bounce here and get that strong rally up to new highs by the end of the year that, again, even today we heard is a strong likelihood from a lot of different people. So we're going to talk about that. We're also going to talk about kind of what's driving the weakness, some pretty significant moves in some different asset classes that are kind of reflecting at least my expectations of where we're going to go, and they never bring me on the TV. At least a couple of times on Fox Business News, but never on any of the other channels to tell you what I think. But you know what I think, and I'm going to kind of share with you some of those moves that are kind of validating my expectations. So we'll take a look at that, and then our trade ideas in one of those sectors that has been struggling here lately, but as previously it was really strong, as now it's kind of settled in. So we're going to talk about how to trade it as it's settling in before we have to worry about the next earnings cycle. So let's go ahead and get started. Today is Wednesday, February the 22nd, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. If you're watching us here on our blog, check out some of these other things on the right, including our Market Outlook live video that I do at 3:30 Eastern Time every day that I do the Market Outlooks. Come down here to the bottom, click this heart. It opens up that tab. Hit that like button. Look, we almost got 100 likes, so we're really close on the last one. Click that thumbs up icon. It takes you to this tab. Hit that like button there. Again, the more you do that, it really helps us out a lot. By helping get our content out to all of our followers on these platforms. That's why we always ask. So thank you to those who like us, like our stuff day in and day out, and those who don't, you can do right now while you're watching, just with one easy click here. Okay, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see we ended up today down slightly below 4,000, a little bit off of the lows of the day, but still right there, breaching the 4,000 level. Of course, we breached it yesterday by a few points, and we're not significantly down below that. It is a small range today, obviously less than half, about 2/3 the normal range. So very small range, nothing to get too worked up about for sure. Not surprising, the intermediate line's down. In fact, your intermediate line is probably maybe another day away from crossing not only out of bullish territory, but also below market sentiment. So that would be a pretty significant cross, especially if we continue with the decline and break the 2.5% level tomorrow. So really important day. If we can bounce off of this support, this technical support off these Fibonacci lines, and get back above yesterday's high point, then that would go a long way to this, contain, like, being bullish, right? Finishing this year on a good note, not getting what we've been expecting for quite some time. I don't think that's going to be the case. I think more than likely we are going to continue lower. But if we are going to continue higher, now's the time to do it. Now's the time to get off of this level, get off this, hold this for support, bounce off, get above this high, get back above the moving average, get back to dark green shading the green line, avoid bearish territory for the intermediate line so we can maintain this intermediate run and really just get going, right? That would be the ideal scenario. I think it's just unlikely. I think it's more likely instead that we'll probably go all the way down to here to 3,800 before, I think we'll hit 3,800 before we'll hit 4,200. And then we'll be looking at whether or not we're going to hold that support, because that's going to be a tremendous support. It's already held once. That's going to be a significant support level on the way back down. I believe we're most likely headed in that direction after this failure to get above these highs we've been talking about for quite some time. So, there's a lot of factors. Here's one. We are, like, you got the golden cross last week, but you're negative. Your PPO is falling back down. It's almost back to negative. You got the red arrow, so we're trading back below the 10-week moving average. After a transition candle last week, it's a pretty obviously bearish candle this week. The moving average for the Hakunashi candle, so this down here measures the size of the Hakunashi candles. You can see the moving average here is almost about to cross below zero. That tends to happen on these bearish runs. We're still below it. The green line is still below the purple line. So we're still, we're just barely starting what could be a multi-week bearish move to the downside, in my opinion. As you can see, last time it's taken about 8 or 9. This one took 13 weeks. This one only took 3, and the hope is, if we're going to be bullish, the hope is that we have that kind of move again. Or even better, and not like something like these, right? And this kind of move is what you get on bullish markets. So you just have a few weeks to the downside with a red arrow, and that's it. And then we come right back up, with a green arrow just a few weeks later. That's the ideal scenario, of course. Unlikely, more than likely, not going to be the case this go around. And obviously, if it is, if it changes, we'll change with it, right? If we get new evidences to change our expectations, we will. As of right now, we have 3 red arrows across the board, except for on the Qs. The Qs are still trading above the moving average. It's still holding up. It's still got some pretty negative momentum. All of these have pretty negative momentum. And you've had multiple days now of pink shading. In fact, you're on the 4th day of pink shading on the Dow. Again, that suggests that you're probably due for an intermediate decline. If you only get 1 or 2 days of pink shading, you can bounce off of that. But when you start to get more than 2, then like 3, 4, 5, like a whole week, then now we're more than likely, especially again if we get to the 2.5% mark below the moving average, because that makes it a lot harder to get back above the moving average. Speaking of, you can see you are below that 30-day moving average. You are still above the 50 on the S&P, so that's actually a pretty decent sign. The MACD has gone negative, well below its moving average. Stochastics is also into bearish territory, also well below its moving average. You can see the diamonds is actually below its 50-day moving average. It's really broken down hard. It's got a very poor margin of safety. See, it's very top heavy, so it's got a very poor margin of safety. So if we're going to retouch October lows, the diamonds have the most to go and the least support to get there. So whereas the S&P has got a lot of support between now and the October lows, including the point of control and then that low point to get to the October lows, the diamonds do not, right? The diamonds, that is where the major support level is, near those October lows, and there's not a lot of support. The point of control is above us. So, if we're going to fall down, the diamonds have the worst to go, right? It rallied the most, probably shouldn't have, but it rallied the most. And now, in any kind of bearish move, it would more than likely feel the brunt of that move. Whereas the Qs, on the other hand, like I said, not only is it still above its 50-day moving average, which is actually below the 200, but it's still above the 30 slightly. Now, they are, again, MACD is declining, Stochastics is declining, it's dropped below 40. We are below the 17-day moving average, so we are in a bearish move, but at least it's not as bad. IWM, again, it's a little bit better too. Again, if we're going to get to October lows, you got the point of control, which is a little further down, and that low point there from December. So it's going to take a little bit more, as well as this major support too on the Fibonacci level, to break down. But it is below its 30-day. It is below 17. It broke the 17 and the 30 in the same day with a pretty significant move yesterday. So that's a pretty significant breakdown. Obviously, its MACD and stochastics are also into bearish levels. MACD almost about to cross below zero, as it's been below its moving average here for a while. Let's look at some of the other oscillators. We'll look at the DMI for the S&P. There is an obvious crossover here with the ADX still above 20 barely, but we're barely above 25 on the negative. We're barely below 25 on the positive. So it's not like we're like really. There's still an opportunity we can bounce right off of this bull tag. Remember, we got the bull tag on the market forecast chart, which either starts bearish runs, as we've seen here this past year, or starts really strong bullish moves. So that's still a possibility. Even the DMI suggests it's still a possibility for the S&P. The diamonds maybe suggest otherwise, as the negatives, the positive indicator is way below 25. In fact, it's well below 20, and the negative is still not above 25 yet, but it's moving in that direction off of much lower levels. So the diamonds probably suggest a little bit more bearishness than what the S&P is. So we, again, more than likely we are leaning in that direction. especially with the CCI breaking below minus 200. See, that didn't happen over here. It got below minus 150 both of these times, but it didn't get below minus 200. It obviously got below minus 200 over here when we really started the bearish decline on that run. It never got below minus 200 coming off that August peak, but it is now. And it almost got below minus 200 again today. It got below to minus 198. So that's a pretty significant move. It's not been shared with the RSI yet. So we need to see some confirmation on the RSI. It is below 50, but it needs to really solidify that bearishness by getting below 40. As of right now, that's not the case. Looking at the Ichimoku cloud, no bullish trend anymore, so we're done with that. The diamonds obviously has been done with its bullish trend as well, and it's below its cloud with a negative rate of change, more negative than what you're seeing on SPY. Right, SPY, you're still actually slightly positive. The Qs, remember, is a little bit more bullish, so it's actually way more positive, the rate of change on the 26 days, and actually still has a bullish trend and still easily above the cloud. So you can see how the diamonds are leading things lower, which is why, again, in our classes, we've been hedged towards the Dow more than the Qs. We have been hedged towards the Qs, but we alternated to the Dow because of that poor margin of safety, and now we're seeing the reasons why. Looking at the Keltner channels, you can see we are, again, in the lowest quartile. Getting in the lowest quartile starts to get the bandwidth to rise, either the upper or the lowest quartile. Of course, when you're just starting to get it to rise, you want to break out of the bands, either to the downside or to the upside. So we're not outside of the bands yet, but you can see the momentum has shifted. We got the red dots. That's usually where momentum shifts, is through the red dots, from one direction to the other. So we are in that direction now, shifting to the downside. You can even see on an intraday level, again, we close below yesterday's low. That's a bearish close. We'll see how we finish, in the after hours, especially with some important earnings coming out. But as of right now, we are below that close there. And you can see it was a lower high and a lower low. And you can also see, too, again, after this low comes off the table, then today's low becomes a new low. So if we get a new low tomorrow, then that means we'll get a break to 100 on the red line, which starts your bearish moves. So just like, and from a really low level, too. Now, last time, we were at a lower level, and we didn't really break out. You can see some of these other breakouts. We were right around that level 2 on that breakout when we got the spike to 100. When we got to the spike to 100 on the green line, we were at that level. And then, of course, over here, when we got the spike to 100, you can see the price channel width is right just above right about 5.5%. We're just barely below 6% now. So we're pretty low levels for how tight this range is. Again, suggesting, especially with that low Bollinger bandwidth and the Keltner channel, the bands being inside the Keltner channels, that we are due for a breakout move, a trending move. And obviously, if we had to pick which side, right now we'd be looking more at the downside, right? More at the downside here. Volatility is also breaking up. It is down today, not down by a lot, but it is down today, but not on a relative basis. It's actually still holding above 95%. It hasn't broken above 100 yet, but you can see the correlation with the VIX to the VVIX is also a day or two away from getting back below 50%. Again, that's a typical environment that sets up for a bullish move for volatility. I've already told you before that volatility is typically bullish this time of year, right? This is the seasonally bullish time of year for the VIX. We're coming up off a low point that's much lower than normal on the VIX. Normally, we're actually positive on the year for volatility. That's over the last 5 years. Let's go 20 years. Normally, we are pretty bullish, not by a lot, but we are coming off of a positive low point. We are very negative. So we're almost positive on the year for volatility. But again, we generally move higher from here to March expiration, options expiration. And you can see when you look at volatility on this basis, we are moving higher, right? We are, it has broken up. Let's go VIX, there we go. It has broken above the 50-day moving average, getting into that gap between the 50 and the 200. The 8 and 17 have crossed above their 30-day moving average, and the 8's already crossing above the 50. So it has changed directions. Volatility is shifting its regime from a downside regime to now an upside regime. How long that lasts, we'll see. But last time it lasted from August till the middle of October, and we'll see how long this one lasts. And it could at least seasonally, we're looking at a month. But if it lasts 2 or 3 months, like the last few times, then of course we're looking at a move on the S&P that could very well this go around get us below the 200-week moving average, especially if we were to get below this 3,800 level, this volume node, and there is no volume below 3,800 until you get down towards the 3,200 level. So I mean, we are susceptible for this bull flag to turn out, or whatever you want to call that continuation pattern, to turn into something and really make this fake out. Like I've mentioned to our market scholars, this fake out has a lot more potential to be a lot more devious than the August fake out did, because so many more people are more bullish now than they were then. That we've just sucked in a lot of it's a suckers rally. This was an even worse suckers rally than the August one is. I mean, you've got the Tom Lees of the world out today, and everybody claiming how we pretty much have 100% likelihood of being bullish, of getting new highs by the end of the year, like 100% likelihood. That it's really sucked in a lot of people. I told you before, the institutional investors, and the new highs, new lows got to negative levels. But the institutional investors is really bullish, more bullish than what we've seen. When you get that suckers rally like we did in mid-2008, it opens the door to a bad fake out that can lead us to new lows to the downside. All right, now let's take a look at what's moving this price action. You can see the markets on a 3-month rolling basis here is close to getting negative. We're still at 1%, so it's still hanging in there, and especially the international markets are hanging in there a lot better. But if you look at commodities are at their lowest levels of the past 3 months. I told you before that commodities don't correct in bull markets, and commodities are clearly in correction mode. We are below the value area now for the 1-year chart. Easily below all these falling moving averages. When you look at the weekly chart here, again, the week's not over, only 2 days, we got 2 more days left. But you can see we are easily below the 17-week moving average, have been for a while. The 30 weeks below the 50, we got no support volume-wise until we get down towards 19.5. 1 second. There it is in correction mode, and that's not a reflection of bullish markets. When you look at UUP, you can see the dollar is working its way back up, and it's again, it's a safety trade. So in risk averse environments, the dollar will rally. Now I don't think it's going to rally to the same extent. The last time we went here from around these levels, from this 50% retracement level up to the 100, we went up really quickly. In 4 weeks, we were already pretty much here. I don't think we're going to ramp up and go parabolic on this move, but we are clearly bullish. We are above the 17-week moving average. Week's not over. The MACD is above its moving average. Looking at the daily chart for the dollar, you are clearly above the point of control now, as well as above these moves. The 8 and 17 day are crossing above the 50. I mean, we are working our way higher here. Same thing with yields. Yields did not go up as much today, but they're still up. Elevated, far more elevated, which is putting pressure on bonds. I don't expect bonds to go down too much. Again, it's also a safety trade. So if the markets do get more and more risk averse, then you'll see bonds might go down a little bit, but not very much, right? I think bond yields have caught up to. I don't think we're going to get an uninverted yield curve we're not going to get an uninverted yield curve on either of these. The 3-month and the 2-year is probably the closest, but I don't even expect that one to uninvert. I don't expect these to uninvert before this bear market starts. So I expect them to uninvert afterwards, after the Fed starts cutting rates. But until then, we'll be uninverted for quite a while. But they're just not as uninverted as they were. They're definitely off of their lows. Not this one, not so much, but the 10-year and the 3-month for sure. Remember, the 3-month essentially is the effective Fed funds rate. This one's going to work its way up. I don't expect the 10-year to work its way up too much higher. Here's the 10-year. Well, I think it will probably work its way towards maybe 4.25, back up towards these highs, but not very much higher than that. And we'll end up with about 100 basis point inverted curve between the 3-month and the 10-year. And that's about, again, that's kind of the extent of the bearishness, and I think that's where the Fed will stop raising rates when it gets to 5.25. Right now, the odds of being at 5.5 by June are 76%. You got 100% odds for a rate hike in March, 100% odds for a rate hike in May, and 76% odds of rate hike in June. If we don't get that one in June, we stay at 5.25. We do have 17%, so roughly 83% odds that we'll still be at 5.25 by the end of the year. So, I mean, the futures market has caught up. I think the bond market is pretty much catching up to where you can see, again, if I were to go back to the last time that we had the levels towards this point, so here's the 5.25%. Like, we've never had it this high, but the last time we had it this level was in early November. And if you look at where the 10-year yield was in early November, that was right when we were at the 4.25%. So we're not quite there yet, and we're obviously a lot more hawkish now than we were then. So that's why I think we will get up to maybe 4.25%, maybe 4.5%, because these numbers are much higher than they were. Like the odds of a rate of these rate hikes. I mean, even going to the May, the last rate hike that we're pretty much guaranteed for now, up to 5.25%. Again, in early November, it was near 80%. So we're a little bit higher there. I think we'll get a little bit higher, and we're not higher here. So we're not, the 5.5 is not higher than it was then. But again, I still think around 4.25% is where the 10-year gets to, and I think that's done. Again, that puts pressure on equities, pretty much starts the intermediate decline, which at that point I think things inverse. And the bonds start to rally with bearish stocks, and we make our way into the bear market, in my opinion, into the bear market starting now as we move through that 200-week moving average with these patterns on these different asset classes. Let's take a look at the sector rotation. So let's come down here to the sector rotation. And again, as you can see, the market still got that 1% move over the last 3 months. But you can see it's been these sectors that have led the way higher. They're still holding their ground. Your safety sectors have been the worst. Energy has really been the worst. But your safety trades have been kind of the worst, and your other cyclical areas matching the market to the downside. If I just look at today alone, here, let's change this to today alone. I'm going to, there we go. Then you can see discretionary communication services actually did okay. And let's go back to yesterday too and include this 2-day little drop we've had. That's why discretionary has done so well today. Right? It was the biggest loser going into today, and so was communication services and technology. They were down quite a bit. Financials as well. They're holding better. We'll talk about financials here in a second. And you can see staple materials and energy are doing better than the markets despite the rising dollar. They're doing better, but it's really technology, industrials, communication services, discretionary, real estate, all getting hammered. Those were the ones that got hammered for most of last year. They're getting hammered now. Again, coming off of that February 2nd exhaustion move, starting with the 3rd and working our way down. You can see, I mean, look at that. Communication services down 8.5%, discretionary down 6.25%, technology matching the 4.5% decline on the markets off of that exhaustion peak. Staples only down 0.5%. Energy was doing very well coming off that peak, up 5%, but then now has joined the party, right? It's down here, down 3%. Not quite matching the market, but matching the industrials, matching financials. And you can see utilities and state and healthcare, not surprisingly, outperforming the market in a risk averse. So the real estate, though, I mean, again, real estate leads that market, and the fact that real estate is just so bearish, this kind of goes to show just where we're at right now. It's not a safety trade. It's the getting lumped in, and that's not a good sign for risk appetite in general. All right, now let's take a look at our trade idea of the day, and I want to take a look at Goldman Sachs. It's very similar. It looks very similar to the market in a lot of ways. A bull tag, bearish short-term sentiment, but not significantly below its moving average. The difference between the market and Goldman Sachs is Goldman Sachs has been farther up above its 200-day moving average to the point where, remember, the markets has barely got its golden cross Goldman Sachs got its golden cross a while ago. It got really caught up in that burst on the Dow, and then it's held up much better, and it's been really sideways pretty much ever since. Whatever the other thing too is when you look at it, when you look at it here, like you're a negative rate of change right now. The red line's below the close. But tomorrow, the red line is going to be well above the close. But again, barring a big drop tomorrow, which that was earnings, so highly unlikely we're going to get a big drop tomorrow. So you're going to shift back to a positive rate of change. You're in the cloud, but you're still above the cloud, and you had a bullish trend that's been ended here. If you look at the weekly version, you still got a bullish trend going, and you're above the cloud there. Compare that to SPX. You're below the weekly cloud, and you don't have a bullish trend going. So it kind of gives you an idea. We're a little bit more bullish than the broader market is. So it's holding up a little bit better. Again, not in the XLK, XLY, XLC, or real estate camp. The bandwidth is down. We're not in the lowest quartile of the bandwidth. And you still have green dots here. So the bands are actually still outside, though probably only for one more day outside the Keltner channels there. So we're pretty sideways on the stock. Looking at I don't think we looked at the RSI and the CCI. The CCI is down, just like the broader market, but your RSI clearly in sideways levels and has been for a while. It's been more sideways here lately than any of these others. So it's a pretty neutral chart in my opinion on Goldman Sachs. And so what I decided to do here was to do an iron condor spread. Here, let's push this down. Where I sold the 20 deltas, so sell the 340, buy the 335, buy the 335. This was closer to 20 deltas during the Market Outlook live session, so we sold that one at 375, bought the 380. I prefer to avoid the half 50-cent strikes anyway. So that puts us at with a normal risk. Again, we don't have to worry about earnings. A normal risk and a pretty decent reward, and those break evens are right there. So when you look at the break even relative to the full length of the chart, I don't think we're going up to new highs. So I don't worry about the upside. And of course, if we do, it's going to be breaking out. So it's going to be pretty bullish. We don't want to be an iron condor anymore. But to the downside, look at where the break even is. You got some obvious lows. It's not the October lows, but some obvious low points here. And the point of control, as well as the value area, top of the value area. It's actually above its value area. So you've got a lot of support below you, and again, not too much worried about new highs above us. So I really like where those break-evens are for the next 3 weeks. Again, without having to worry about earnings until we get closer to April expiration. So we're kind of in this kind of no man's land where I got a pretty decent credit. As long as the market doesn't really fall off a cliff here and bring Goldman Sachs down, but you can see financials have been holding up better, so I don't think we have too much to worry about that. From that regard. So we'll do, and if we do, again, I'm willing to lose $537 because that's what we're trying to make on this. So if we get to that point because it's broken out one way or the other, then we'll take that loss, and obviously more than likely it will be offset by other directional trades to the downside that we have, whether it's in this sector or in other stocks, just in general. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Subscribe to our website at marketscholars.com for free, like I showed you earlier. And follow us and like us on Twitter and Facebook as well. Or LinkedIn for that matter too. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.